Go across now and welcome our first guest on the show. Nilesh Shetty of Quantum AMC is now with us. Nilesh, let's talk about the markets, what's the way ahead, and then we can take it to which sectors you like or you don't like.
Yeah, I mean, the entire thesis of this rally, which played out over the last 1 year, is that India is at the cusp of a massive Capex revival. I mean, there are three, four factors which are driving it. One is, of course, very low interest rates, perhaps a 2-decade low interest rates. Government intention that they're going to keep fiscal policy very loose, and they've given targets which are much elevated than we've seen historically. You are seeing some signs of Capex activity picking up in select sectors, be it renewables or airports. But that is the broad thesis. And you look at where markets are today, they're about 40% higher than where they were pre-COVID levels. And the earnings growth of the next 2-3 years is expected to be very high, primarily driven by banks lowering provisions. And you have some pickup in commodity earnings. So, our view is that people who are invested stay invested. There is no reason to exit the market. If both these factors, very loose liquidity and earnings uptick, continue, it's unlikely the markets will correct significantly. You might have short corrections, but you should expect markets to move higher. Perhaps the pace of the rally will slow down. But by and large, we expect markets to move higher over the next couple of years than where they are today.
How would you look at the sectors that you would want to play? So Capex revival, how can you play these Capex names?
Yeah, I mean, this is where you have to be careful because a lot of it is already getting factored in the price. I don't think the traditional plays of Capex revival, engineering and capital goods are that cheap. And construction companies are not that great quality. Pockets where there are value remain banks, where valuations have still not reached levels which you would call expensive. But if you just want to play the Capex theme, then perhaps they would be the best place to play the Capex theme. But broad general economic revival, of course, you can have other companies as well, including consumer discretionary, including auto companies where valuations have still not reached levels where you would think they're very expensive. So if you just want to play broad economic recovery, then these two sectors might work. But just pure Capex plays, I don't think there is that much value outside of banks.
Right. In terms of banking names, you said there is valuation comfort. But on the other hand, aren't they massively overweight as well? Most of the large cap names or, the mid to large cap names are owned by almost all fund houses because it's been, the record weighted sector for the last 1 decade.
Yeah, possible. My view is more from a fundamental perspective. I'm not looking at sort of technical reasons of overweight, underweight by sort of institutions. And of course, the entire rally, if you look at the data, is primarily driven by retail. Institutional participation has not been that out sort of above historical levels. So they might be owned by a lot of institutions, but just looking at where the earnings trajectory is coming from and what companies are going to drive the earnings leg over the next 2-3 years relative to where they are trading at, banks perhaps look a lot more comfortable in terms of valuations than some of the other sectors.
Right. We also, if you look at the last few days, you're getting a sense that, all the laggards are trying to play a catch up. So FMCG multiples are now at a new high. Stocks are rallying without any news flow. In fact, weaker monsoon, poor consumption, GDP is being ignored. Cement, or, we can say that insurance is trying to make a comeback in the market with, some of the insurance names doing well. What is the sense that you get? Should one look at laggard names, and banking would be a fit over there where you just said that it's not done well?
Some of the sectors that you mentioned, including consumer staples and insurance, are not that cheap. The reason that they underperformed in the first place was their valuations were very expensive. And the other sectors, their valuations had collapsed, were offering much better value. And that is where you saw a significant rally happening. Perhaps these sectors are also running because at the levels that we are, people want a bit more protection in their portfolio. And given that they've not rallied that much, you might see some reallocation happening because of that. But it's difficult for me to believe that in a cyclical upturn where Capex cycle turns in a big way, especially in the initial years, consumer staples with those valuations might outperform other sectors. They might move up, but I think they might continue to underperform other sectors much more geared to a cyclical recovery in the economy.
Right. as you said that people want to play a catch up as far as these names are concerned, or trying some get some defensive names. So how should one position the portfolio now? Valuation or the price at which you buy is the most important. That continues to be the thumb rule.
That, especially at levels that we are right now, that assumes paramount importance. See, you want to play the upside, but you also want to keep at the back of your mind what happens if the markets were to correct. Right, there are enough factors which can drag the market lower, including a third wave. I mean, given where sort of vaccination is in India, and given that we are just entering the festive season, there is the probability of a third wave just increases. And in that scenario, all these sort of assumptions that are being built into strong earnings revival, that gets deferred. You might have a correction at that point in time. So you also want to add some protection in your portfolio. So just if you have good quality companies at reasonable valuations, they will offer you downside protection as well. So it is a stock picker's market right now. Just blindly buying into sectors with momentum might not work.
Right. How would you rate the recent listings, the euphoria around that? What does that tell you?
I mean, there are classic sort of indications that there's some sort of retail euphoria in the market. You saw that last in 2006-7. Again, there are quality companies, and some of them deserve sort of valuations that they're getting. But I it just generally in an IPO, at least our advice has been that they tend to be overpriced, and you might get an initial pop, but over a period of time, retail investors don't make enough money while investing in IPO, because most of the merchant bankers price it very aggressively and leave very little for the retail investors or general investors. So at least apart from sort of signs that there is euphoria in the market and people just want to invest in equity markets, I would not give too much credence to recent listings and the valuations that they're listing at. I expect a lot of them would be lower in a year's time or 2 years' time.
Right. In terms of Capex names, so you said that it's difficult to identify Capex companies, but don't you think the people who have survived, people who have managed to deleverage, not focus too much on equity from here on, or focusing not too much on aggressive bidding, aggressive debt, aggressive equity raising from here on, these are companies that can give you multiple returns then?
No, I mean, the thing is, such companies are already trading at valuations around peak that we saw pre-COVID. So just for me, given the nature of business and given that if sort of the capex cycle picks up, of course they will do better. But just how much is already in the price is what is concerning in that bucket. So just to get names there at reasonable valuations, quality names is not easy. That is where our concern is.
Right. Thank you so much, sir, for taking out time for us. Always good to get